All right, guys, we are back. Stock Street University. My name is Jay Wise, and I have my brother Q with me. Q in the building.
Yes, sir.
All right, we're going to be talking about 4 things that are impacting investors and the markets today, and probably for the rest of the year. So before we get into the information, what they got to do, Q?
Smash. No, I'm joking. Don't even smash. Destroy the like button. Like, subscribe, hit the notification bell. And if you like the content or if you have a different perspective or any questions, feel free to go ahead and drop it down in the comment section below, and we'll be able to go ahead and interact with you guys and have that conversation at a later time. So let's go ahead, Jay.
Yeah, man.
Let's
So there are 4 things that are impacting investors and the market. Possibly these 4 things is creating a lot of fear. If these 4 things could be resolved, we can see a very strong market activity. So we have number 1 being the uncertainty with the virus. Number 2, supply chain issues. Number 3, interest rates, and number 4, which got a lot of people spooked, and that is inflation. So let's get into it. We have number 1, the uncertainty with the virus and the variants.
Man, a lot of people seen what happened with COVID-19, right? With the one that hit us last year in 2020. We had a lot of unfortunate people losing, a lot of unfortunate deaths and circumstances, a lot of medical illness, a lot of economical changes as well, between business shutting down, people losing their jobs, a lot of money being poured into the economy from the government. And with that being said, one, you have a large amount of people that are just eager to get back out into the world after having been under lockdown for so long. That in that perspective alone, right? If another variant breakout happens, now you're looking at another shutdown of travel, another travel ban, which is going to hurt travel industry. You're looking at hotels and airlines looking at another price drop on the market, which means less money coming in. You're looking at more medical expenses coming about, which means more money being poured into the medical sector to figure out how to be able to battle off this situation. You got people getting vaccinated for the COVID-19, but no true certainty as how this COVID-19 shot is going to play its role against fighting off the Delta variant. And so with that being said, now you're looking at, if we can't get a grasp on this thing beforehand, we might be looking at another shutdown, right? Which economically, a lot of businesses barely made it in 2020, right? Some companies profited greatly and were still able to keep the ball rolling, but a lot of them suffered greatly. Now, can they sustain another shutdown right after this? It's hard to say. And as far as the consumer side goes, people are already uncertain when it comes to economic changes, being the fact that they just went through what they went through. A lot of people are a little tight on their money, and they want to spend it on things of value and try to find price or shopping and things of that nature. So from the consumer side, you got scared money, right? Which means people are less eager to put their money into the economy. And then from the economical side or the business side, you're looking at companies that might not be able to sustain another major hit like this. On top of that, you got people scared to go back to work, which we spoke about unemployment rates, right? You got companies that's trying to bring people back to the office, and it's like, I'm not going back to your office. This thing is not done yet, right? Like, we still have a whole other variant that might be coming through. And if that does happen, you can expect to see another decline in the markets. Now, being that we have gone through the first wave of COVID, will this decline be as substantial as last year? Probably not. But who's to say, right? It all really depends on how this thing is, how we operate and how we move against this, and how we're able to keep up with it. But yeah, I can see where the fear is. For me, on the social side, I can understand the fear people getting sick, people losing their lives. That's an unfortunate circumstance and situation. As an investor, though, I'm not gonna lie. The market takes another drop. I'm gonna be right there, cash on hand,
right.
buy the dip.
Mm-hmm.
Find me some solid companies, and I'm buying on a dip. Ride that bad boy up.
So I was thinking about this, and I asked the community this in the Discord, in regards to, do you think the reopening was a little underwhelming? Because a lot of people were positioning themselves and purchasing stocks stocks that had a reopening opportunity. You had people buying liquor stocks. I was big on that. Because you had
we spoke about that on the TikTok.
Yeah, you had clubs reopening. You had a lot of opportunities there. Airlines, travel, cruise lines,
hotels,
Airbnb, of course, was one of them.
Rental companies,
rentals. To me, I felt for this summer, because we were banking on things reopening and things going crazy for this summer. Do you think that a lot of these stocks didn't do as well as what the public expected, or the retail investors expected?
I mean, being a co-founder of Stock Street, we move a little different, the retail, they don't understand the game the way that, some of the institutions may. But no, but all jokes aside though, from either institution or retail investor, I think I'm gonna just say, I think we expected things to happen a little quicker than they did. And one thing we didn't expect for would be the probability of experiencing another one, such as the Delta variant. When the light started to shine at the end of the tunnel, when we started talking about COVID-19 vaccines with Pfizer, Moderna, Johnson & Johnson, AstraZeneca, and all those other companies that was publicizing, working on this vaccination. And, when we started seeing the light at the end of the tunnel, it was just like, okay, this is going to be great. But at the same token, a lot of people feared that once that started to occur, people would go crazy. And once people go crazy, then you're going to see situations like you've been seeing where, you got people refusing to mask up. People now that the vaccine has been going on and they're saying, oh, if you have the vaccine, you don't have to wear the mask. You got a lot of people not wearing masks. Half the people still not even vaccinated, but they're still not wearing a mask. And then they turned around and said, even if you have the vaccine, still please wear a mask.
Right.
You still don't see a lot of people wearing masks.
Yeah, you're creating confusion. Yeah.
Right. And now you still got a lot of people not wearing masks. And more every day, you got less people wearing masks and less people wearing masks, less people wearing masks. So now you have the Delta variant that's on the rise, where we may be escalating the situation in the wrong direction. Where we may be actually spreading the situation, not allowing it to die down to be able to gain control.
Right.
Which economically, what that's going to do is, I'm going to be transparent. As per our future conversation on the video, I don't think the government can withstand dishing out more money to the people. So if we don't, as people, come to a commonality of, all right, let's be mindful of our own risk factors as well as the risk factors of the people around us, we're going to see another crash. And if we do, stimulus may not be so easy to come by, which was going to lead to a bigger crash.
Right.
And that's only going to dig the hole deeper.
And that's the thing that a lot of people, because you have a lot of people who really don't understand the fact that even though you might have never had gotten sick from COVID, it is still going to impact you. Okay? That's why it's important for you to be mindful of other people. You know, whether you think it's silly for you to wear the mask, at least be mindful. Because the thing is, although you don't get sick, it's still causing a lot of people to lose their businesses. It's still causing a lot of people to
lose their jobs,
lose their lives, you know, get ill. Whether they don't die, they still are gonna end up with a bill from the hospital. You know what I mean? That's not gonna go away.
And anybody who had medical bills don't come cheap.
Right. And that very thing is impacting everything else that we're going to talk about, which is the supply chain, right? Because of the whole sickness thing that's spreading, you have people who didn't want to go to work. You have people who still don't want to go to work, which is also creating this bottleneck in the supply chain, right? You
got trucking companies that you know, they can't operate, you know, to the full capacity, which means now you're looking at supplies not being able to make it to locations within reasonable time frames. So now you're looking at prices going up because, well, if I got to do the extra work to drive this merchandise to transport it from point A to point B, and I'm stuck in traffic and I got to extend my workers and I got to XYZ this, now you got to pay the extra price, which the companies don't pay the price, right? The consumers
do. Passed on to the consumers, right? So let's just jump into it with the supply chain, right? And since we're talking about, you know, you just mentioned that aspect being disrupted, but here are some other sectors that are going to be being disrupted by the supply chain issues. It's manufacturing. You have construction. You got retail trade. You have wholesale trade. You got food services. You have administrative and support services, utilities, healthcare, arts, entertainment, and recreation. Real estate has been impacted, probably for the good if you're a seller, but not too good for you if you're a buyer, right? Rental and leasing, transportation and warehousing, mining, oil, gas, that whole energy sector is impacted. Right? You have the professional, scientific, and technical services, educational services, because, you know, some people aren't sending their children to school, so they have to either figure out new ways to teach these students through Zoom and those streaming platforms. And you have financing and insurance. So a lot of different sectors are impacted from this bottleneck.
Now, insurance is one of those things that's impacted for the better and the worse, right? Because now they're forced to make payments as opposed to just taking everybody's money or every month. Now you're forced to make some dang on payments. Give me some money. Right? But at the same token now, when insurance companies got to start making payments, you know what happens to premiums, right? They got to go up. When insurance companies see that there's certain areas of high risk to having to make payments, premiums go up. So, you know, you got to be mindful of that. When you're looking at, like you mentioned, the transport sectors, when you're looking at the shipping companies, when you're looking at the trucking companies, it's costing a lot more for them to be able to do what they have to do, which means consumers are paying more. We already spoke about the fact that people aren't going to work because they got to do homeschooling for their kids. So now they want work from home opportunities, which means you got companies who can't afford to have work from home employees losing employees. You got people who are quitting their job because, well, I don't want to go to the office no more, right? And I don't want to be at risk of getting sick, right? And then losing my life or whatever the case is. I'm leaving, right? So now we're still losing employees, which means companies can't provide the level of service, which means they're going out of business. Less economical capital flowing. Right. You got, you know, you got schools, which in this particular situation, you know, less money flowing into the school for brick and mortar maintenance, right? Because schools are being taught from home.
Yeah.
But that's still, you know, depending on the city, state, county, and all of those things, it's still not enough to pour back into the community, right? You're looking at Yeah, there's so many different ways between the housing sectors. You look at the price of resources. Lumber skyrocketed this year, right? To build a house was crazy. You know, to buy a house, you're looking at the housing market was inflated exponentially. Houses valued at over $100,000, $200,000 more than they were valued at just before the pandemic. You're telling me in 1 year, your value jumped over $100,000 with no renovations? I'll sway.
Yeah. It's crazy.
Right?
Craziness.
And so, when you think about all of these things and you take into consideration the fact that interest rates are at an all-time low and, oh crap, well, let me go get a new house. Well, there's not a lot of people trying to sell their houses because they were able to refinance their houses at a lower interest rate. So cool, I'm gonna save some money now, right? Let me keep my house. I'm not selling. Housing inventory went at a low, right? Low inventory, high prices, right? Which means you're stuck where you're at. And if you're trying to sell your house, well, now you gotta go find a place to buy so you can move into. Less people trying to sell, higher prices, right? If you're just doing mild renovations on your home, resources were skyrocketed because of this, so with everything going on, it kind of plays, it's Lion King says, circle of life, right? You got to understand when people not working, people not living, and everything else that's going on, you're going to see an influx in other sides that's going to impact you directly or indirectly, regardless of how you tend to look at it. So with the supply chain, which ship was it that got stuck at the canal?
I forgot the name of the ship, but yeah, I know what you're talking about.
And that was how long for that halted shipping for like a month.
Yeah.
Right? So that interrupted the supply chain.
And then you have the other situation in China. You have the that one port in China that got so yeah, man.
Yeah,
so
you had that.
So one more thing to add in regards to the supply chain is that we have many companies that are still struggling to get materials out, right? A lot of other countries, and you got to understand, a lot of other countries are still battling against the virus and aren't able to produce the goods and materials as fast as they used to because a lot of their employees got sick. You had shutdowns in some areas like India and some parts of China that are still dealing with shutdowns, right? So you have a lot of the goods and services that cannot be produced as fast as they used to. So
car manufacturers got halted. Cell phone productions got halted. Electronics production got halted, right?
Right. Yeah, so
we're at a low.
Yeah, we're at a low. So we have an issue with that. So another thing that's impacting investors in the markets is interest rates. So I have my own ideas about the interest rate situation, right? Because we do have, again, we just talked about the virus and the variants that we're dealing with. We have the supply chain issues, right? And I'm seeing some panics, right? That maybe the Fed will increase the interest rates here, in the coming months, right? If not sooner than that. But I don't think that the Feds would do that anytime soon. Not this year. The reason why I say that is if the Feds... Now, maybe for me, you, Q, and Marley, maybe we'll be like, maybe they should do it because of this reason, right? But if the Fed were to choose to do this right now, we can see that market crash.
Oh, yeah, you're going to see a big pivot. If interest rates kick in, you're going to see a big pivot from the market to the bond market, right? From the stock market to the bond market.
Right.
But so and that's what people are waiting on, right? It's just like, when should I move my money? Right now,
the banks are waiting on that too.
Is,
the banks would love the interest rates to be raised.
Oh, definitely, of course, right? Right now they're making money, right? But they could be making so much more,
right?
So it's like, all right, that's it's like the stock market is moving right now. I'm good. Let me just invest. I'll scout. I'll swing, I'll build value, however you choose to look at it. Probably do some leaps. But the moment you say interest rates jump, considering debt equity, right? Considering debt equity, the country alone is in so much debt right now. Interest rates go up. That will be that's what people are waiting for. When is it time? That's what I need to. When am I going to get the great return on this bond? Right. Let me get some. Let me buy some of your debt.
Right.
Let me get in on this game.
And that's exactly what people are looking for. You want to see those bonds mature properly. You want to see interest rates to increase. And then there's going to be this, if interest rates get increased, you'll see this type of chain of events occur, right? They increase interest rates. You'll see bonds go up. You'll see less people borrowing money, right? Because interest rates are up. You'll see less people, and when less people are borrowing money, you're seeing less people purchasing new homes, right? New or used homes. Less people purchasing new or used homes, housing prices go down, and when housing prices go down, with the fact that people were buying these houses at astronomical numbers, right? Yeah, interest rates are low.
We should not be laughing at this. Right
No,
now,
we're not.
so
but interest rates are low. You have people saying, "Yeah, buy a house, man. You'll never see interest rates this low ever." Yeah, but the price you got it at.
Depending on the purpose of buying that home, that markup value on that home, it overcompensates for the interest rate reduction. I'm just saying, right? Like you may get it for a low interest rate, but you're paying, like I said, $200,000 more.
So, for example, because we've seen crazy numbers, a home that was worth $150,000 today is worth $300,000. So, if you pay $300,000 for a house that was worth $150,000, right? And then prices come down. Oh Lord.
What was it? I want to say it was Zillow. I think it was Zillow. I want to say I was on Zillow, right? And I seen a house. It was selling for like $675, right? So when Zillow has the little chart,
the chart to tell you how
much it was sold for prior, right?
Right.
So in 2019, the house sold for $220,000. Why are you $675,000 in 2021? I said, why? How you jump $400,000 in a year?
But you had people just outbidding other people for these homes. Crazy activity going on. And it's so reminiscent of what was happening prior to 2008. Minus the tranches and the CDs and the packages of you had a few triple A's being bundled with C and D credit rating packages. So man. Right. Oh man.
I mean, and that's another thing, right? At this point, with the interest rates being so low, a lot of people aren't interested in putting their money into the banks, right? Because of the fact that, banks' interest rates dropped from their lows of 5%, 0.5%, or there's 0.7%, or some banks might have even given you an interest rate of 1%, right? So now the typical interest rate that you're gonna see is like a 0.03. Like, ain't nobody trying to get what? Let me slip up one time. You charging me $35. Meanwhile, you giving me 0.03% interest? No, get out of here. Get out of here with that.
Crazy.
Disrespectful.
So let's get
Meanwhile,
go ahead.
Inflation.
Yeah, that's what we was gonna get right into.
Meanwhile, inflation. I got you. You're still looking at a 20-year estimated average of 3.4%, right? So even your 1% to me was not beating the inflation rate. So at 0.03%, keep it. I'd rather put my money into the markets, get a higher rate of return. Once the interest rates do climb in, then I'll switch over to the bond markets and continue getting that rate of return. Now, considering inflation, right? What you have on inflation, right? Inflation kicks in, considering the debt ratio that we're currently sitting at, a lot of people are expecting to see what's called hyperinflation, which means interest rates or inflation rates skyrocket out the gate, right? Now they're saying that they're not going to do that. They're saying that they're going to build interest rates incrementally, which might work. At the end of the day, you're still going to end up with a crazy interest rate at the end of it all. Whether you give it to us one shot or you build it up incrementally, right? So you're just giving us a chance to hedge against the inflation rate. If people aren't hedging against the inflation rate. So yeah, inflation is going to be interesting. And on top of that, I don't know how, I'm interested to see how this inflation conversation works, considering that prices have been inflated anyway, considering to the supply chain demand issue.
Right.
So what you got on it, Jay?
Well, I know a lot of people are concerned because I think it was earlier this week or last week, I think maybe the 16th, when the Feds finally said that, yeah, we might have an inflation issue. And I don't know what data that they saw that made them say, yeah, we have an inflation issue, when you could simply look at the commodities and simply look at what happened with lumber and to see that we have an inflation
How
issue.
can you not see it? Like, it's in your, it's like, you ever see those videos of the person who has who car window is open, right? And the car door is unlocked and the key is inside the car, and they try everything to get the keys from inside the car while being outside the car. Like I seen one video, the dude that they dropped the hanger inside the car, right? He unlocks it, he opens the car door, grabs the hanger, closes the door back, and tries to get it through the window. Like, like it's clear as day that we have an inflation issue. Clear as day.
Yeah.
Like, look at what's happening in the look, like you said, look at the lumber, look at the commodities, look at the semiconductors, look at the consumer spending reports, look at the business bankruptcy reports, look at the food supplies, don't ask me why, because I still don't understand it to this day, but look at what happened with toilet paper and paper towel last year.
Hey, come on.
Right? You can't tell me we don't have an issue. This is expected to come, right? So you can put it on pause and say, no, we're going to be all right. We'll hold inflation. It's not going to happen right now.
You got tapering.
We'll build up slowly. Mm-hmm. We'll taper on the bond yields. We'll buy some corporates, whatever the case may be. Mm-hmm. You're going to give out stimulus. You're going to extend unemployment.
All you're doing is kicking the can down the road.
Not even kicking the can down the road, right? You're watching a snowball roll down a hill as it grows.
Yeah.
Because all you're doing is, that's like saying you got a credit card with no job and you're gonna offset your debt by paying it with debt. You're only building debt. What you think is gonna happen when it's all done? You're gonna need the money to pay this debt back. You're gonna need the money to pay these bills.
But what they were saying was that the inflation is just temporary. It's not gonna be a lasting situation. I don't know how they plan to deal with this, because again, like we discussed in previous videos, right?
Are we gonna inflate then deflate though?
I don't know I don't know even. I don't know how they plan to do this, because think about what we discussed in the previous video. We said that people don't want to go back to work for various different reasons, but let's just focus on the reason of they're not being paid enough. Right. They're requesting higher wages. So if these corporations pay higher wages, they're gonna pass off the higher costs, right, to the consumer. So the consumers have to pay more. Now that the consumers having to pay more, those same consumers are also people who work. So now they're gonna demand higher wages. So then the corporation, you see that loop? So how are you gonna undo How are you going to undo that? How are you going to go back? Because nobody's going to say, hey, you're paying me too much. Lower the wages. I don't know.
I mean,
hey.
They've been passing bills, and they've been talking about raising minimum wage, and that's great, right? Raise minimum wage. I applaud it, right? But just understand that minimum wage goes to $12 an hour. That's great. Congratulations, you're making $12 an hour. But that inflation that you're gonna see in the consumer pricing, right, is going to bring that $12 valuation back down. So that $12 is gonna be relatively equivalent to an $8 an hour, right?
That's all. That's all. That's all.
It's just going to help devalue the dollar. And that's why, understanding this inflation is so important, because, although the Fed may be saying they're not, or they're going to slowly cause inflate, or they're going to hold inflation or whatever, like we said, it's still already happening. You can't tell me you can't see it happening if the price of lumber skyrockets on the consumer or wholesale side, right? To get a piece of lumber, the price inflated. Is that not inflation?
Right. But you know what?
I could be wrong.
But you know what? Okay, this ain't CNBC. This ain't these other.
I actually like CNBC, so we don't take it.
No, I'm just saying. But you know how it is. You do have people who don't value information unless it's coming from an authoritative figure, right? We brand new. We trying to build this platform up and share information with the public, share our thoughts and experiences with the public. But here's one thing that I haven't heard them say, which is the fact that with inflation, with these inflated prices, there's a good amount of the public who aren't getting those increases in wages, right? That's why we talked about the Great Resignation, where people are trying to quit to get higher paying jobs.
With a new company, right?
There are a good amount of the public who are still having to pay higher grocery prices, higher utility bills, and little wiggle room for anything else that they want to do with their costs, right? So, yeah, it's gonna be a sad situation. But go ahead, brother.
I'm just, you almost touched on my cynical side for a second there.
Let it out, man. Go ahead, man.
Nah, I like to be for the people, right? But sometimes I need the people to be for their dang on selves. Learn to stop spending money when you don't need to spend money. All right, that's the first thing. Learn to let's
just say we're talking about the people who don't even have it like that, to where they're not being.
So the people who's not trying to keep up with the Joneses.
Exactly, they're not trying to keep up with the Joneses. Just your everyday hardworking person, right? Because there are a lot of people who don't keep up with the Joneses, right?
Right.
Even though if you go look at social media, it's painted as though everyone's trying to keep up with the Joneses, right?
There's a lot of people trying to keep up with the Joneses.
There
are some that's not, right?
But there are a lot that's not. They really do. They're the prototypical work hard and save your money people. But the money that's being saved is getting eaten into because of the higher
interest and inflation and things of that nature.
Right, right. So what about that person? What do you say about what do we do with that group of people? Because all right, let's talk about it in this sense, right? Because we do have they're high earners, right? That group, and then we have the lower group. The people that we're talking about are in the lower tier, but they're not keeping up with the Joneses.
So for them, I would say go to Stock Street University.
Great answer. Great answer. You know what? Let's end it right there. That is a great answer. We're going to end it right there. Go to stockstreetuniversity.com. Go to the enroll page. We got you.
Go to the resource page.
There you go.
Right?
We got you.
And learn how to make your money make you money so that it's
Big
not
facts.
being eaten by interest and inflation.
Big facts.
But but all jokes aside, in seriousness though. No, so to those people though, like I do feel for those people, right? I do. And the reason why I say that is because, you know, a lot of us grew up off of the notion of go to work hard, save your money, and then one day you can retire, you know, and then you're looking at Social Security or whatever the case may, or a pension of some sort. Now, if you're looking at Social Security as your retirement plan, you're in for a rude awakening.
Yes, sir.
Right? Because
what Social Security? Not for our generation.
I gotta make my own retirement plan.
Exactly.
Right? Social Security has been depleting over the years. And because of that, the age to retire has been increasing over the years, right?
Oh,
so
hold on. Let me add this, Q. With the trillions of dollars they've been spending on these stimulus, oh yeah, they guaranteed by the time we hit our 67 years old age or whatever, whenever we hit 66, 67, whatever, I think it's 66, right? The age of retirement.
Right now, I mean, technically they say 59 and a half to be able to access like your 401k.
Yeah, but when you're officially,
but the retirement for Social Security and all that, I think the new age is like 66.
66. We're not gonna see that, Q. We're not getting no Social Security. I guarantee that. I guarantee it. I'm telling you.
I already know I'm not getting Social Security. They're going to look at me and say, well, your income.
Yeah. But I'm just saying, for people around our age range, right?
I'm going to have to find a way to hedge my income so that I can get my Social Security because y'all been taking it out my checks. Right. I need that back.
Right. But I'm just saying, Q, for people who aren't financially astute, right? That just...
Ooh, you lucky Marley not here using words like astute.
That's what I do to Marley. Shut up. Shut up. But yeah. For those who aren't, you know, there's not going to be Social Security. You might as well consider it, maybe the boomers, right? A lot of the boomers are retiring right now. Mm-hmm. After that, what you got, Generation X? Is it Generation X after?
You know, I do not know the generational codes and the categories and names. Well, I don't pay attention to those names. Yeah. I just know you got the people that's coming, that's approaching 65 now, that's trying to pull out 60. Right. They're pulling out of it. They're pulling out, and you got to understand that a lot of the wealth that's been generated over the past few years came from those people. Right. So now with them retiring, they're going to pull out their Social Security. They're going to pull out their capital out of their investment portfolios because at this point, you know, this is what they were able to do. Right. They were able to generate this capital to be able to retire. So, you know, a lot of them is going to be pulling out of the markets. Right. Which means you're going to see a change in the markets. And then on top of that, you got a lot of the new age who don't truly know the markets, all right? And then you got some who are only now learning the markets, right? So, you know, it's going to be a shift on that aspect as well. And by the time they get to that point of 65 or 66, and even for us, right? By the time we get to that point, all the money that the government has had to pour into us, which I'm going to say it this way, right? All of our money that the government had to pour back into us because they wasn't with me shooting in the gym. But they took from my checks while I was working, right? So all of our money that they're going to have to pour, that they had to pour back into us, they're going to need to find a way to be able to reclaim that so that they can pour it back into the future generations, which is one of the reasons why I'm going to go out and I'm going to buy me a town. Right? I love debt. Go ahead. Get the debt. Let me help you get out of debt. And just know I want my return. And if you can't give me my return, I'm cleaning my property. I'm going to be the debt collector that's going to be calling you at 2:00 in the morning talking about this is an attempt to collect the debt.
You think the U.S. could Because people don't even trade gold anymore, right? We don't have people trading in gold for
It's it's a
U.S. notes.
it's a very small population of
Right,
people
but I'm
that do.
saying as far
Right.
as the population in the mass
Right.
population, they
Right.
aren't doing that. So the government can't pull any stunts to steal the gold, right? Do you think they could do that with Bitcoin? Where they'd be like, yeah, let go ahead, buy Bitcoin. Yeah, do it. And then maybe pull a
I mean,
China. I don't know.
you got some states that's already trying to mine their own crypto, right? You got some countries that's making Bitcoin a fiat. You got some countries
Yeah,
that's talking about doing the same. You got countries like our own that's trying to find ways to regulate
regulated.
cryptocurrencies.
Mm-hmm.
Now, if they do happen to come through with a way to regulate it and actually enforce it, yeah, you think I can't? Now, because you got to remember, right now, cryptocurrency is being taxed as an asset, which means it's being taxed at an extremely high rate. It's not being taxed as income or profit, it's being taxed as an asset, which means it's
Right.
taxed at a higher rate. Um,
And
and
that's
being that they can't control it or regulate it, it makes it easy for people to just say, well, they're going to tax me for this.
I might
Let
as
me
well hold it.
move this right.
Mm-hmm.
I'm going to move it to
A cold wallet.
a cold wallet, and I'm going to hold it, whatever the case may be. Good side is if they do, if it grows and it holds, then if regulations come about and they do tend to acknowledge it as a fiat, then you might get taxed at a lower rate. But take into consideration the potential price rise of it. Depending on how much it rises, if it gets taxed as an income, you still gonna be taxed a hell of a lot because now you're being taxed on profit capital gains. But at the same time, you have the potential of getting long-term capital gains or realized gains as opposed to short-term. But I mean, if you got in at Bitcoin when it was like $1,000 and it rose up to $30,000, and they say, well, we're going to tax you on a long-term capital gain, that's still a $29,000 capital gain tax you're gonna get hit with.
Mm-hmm.
So
I don't know what my tax lady did, but when I did my taxes, because I had sold Dogecoin, I didn't get hit with that tax. I don't know what my tax lady did, and I ain't giving her number out either. That's my tax lady.
I ain't speaking on that one.
Yeah, man, I didn't get hit with that. What was the tax on capital on crypto?
Was it on like 30-some%?
I thought it was more than that.
Or is it higher than? Hold on.
Let's see. Let's try. Let me do my Googles.
So
Or were they considering rate? Oh, 37%.
37%. I know it was in the 30s.
So I think they were talking about raising it to 60. Yo,
bro, they're taking literally over half of your profits.
Yo, let me see if I can find that
when
article.
were you shooting with me in the gym for you to feel the gonads to even think about taking 60% of my profits? Where was you? Right? That's not proper English, y'all. Don't mind me. 60%?
Yeah, here it is. Hold on. I think I found it. Here it is.
And you wonder why people stray away from certain investments when they have certain conversations about taxing and inflation and things and interest rates. It's like you raising these things to clean me out. Like, come on, cut it out. I still gotta. I was about to say.
So it says, regardless of your holding period, 60% of any gains are considered long-term capital gains.
So they're considering 60% of your gains as long-term capital gains?
That was just one of the possibilities when they were going to regulate or pass down regulation on crypto.
Okay. Okay.
Yeah, I seen 60%. That's wild, bro.
But wait,
Damn,
so
we almost had a hour.
no, that's actually not too shabby. Because if it's 60% being acknowledged as long term, that means that 60% is being taxed at a lower rate.
Gains considered gains.
But there's still 40% being taxed
And
as short term.
40% are considered short-term capital gains.
Right, which means you're still being hit pretty damn hard on that short term. But at least you're getting the whole more on the long term. How does that even work? Yeah, that works, I guess.
And it's up to 30. No, I think so. Yeah, I don't think that's it. I forgot the
We're
name.
gonna have to do more homework on that and come back with another video.
Yeah, we'll come back with another one. But yeah, man, we almost at an hour here, man. So, good God, putting in that work. But anyway, yeah, we appreciate y'all watching, listening. For more, or if you got any suggestions for videos that y'all want us to do or talk about, or whatever, put that in the comments or shoot us a DM or whatever. Make sure you visit stockstreetuniversity.com. We do have
if you would like to help
too.
us, definitely. If you would like us to stay off the unemployment list, feel free to go ahead and smash that like button.
Hey, we taking sponsors. If you want to sponsor the brothers, be on the lookout. We do got some special things in the works. We're not gonna say what it is, but just be ready.
We're just gonna say shout out to some people out there. Shout out to people who show support. Shout out to people who show love. Shout out to all the good tax accountants out there who do their job legally well. Shout out to all the good fiduciaries out there that make proper gains for the people and are taking good care of people's pensions and 401s and making sure that the people have something to benefit off of after their retirement, because we know a lot of people won't, and we don't want to have to see our elderly forced back into the workforce because they can't afford to retire. So shout out to everybody. Once again, appreciate you guys.
Peace.